Okay, welcome. Welcome everybody. It's absolutely brilliant to see everyone here today. This event is actually 2 years late. We were supposed to be here around February, March 2 years ago, and we all know what happened in between, so it's brilliant to see so many people back out. Thank you for coming. My name's Gareth Hector. I'm Head of Marketing here at Westwood Global Energy Group. And as I say, over the last 2 years, we've actually been running about 30 webinars. Thank you. Well over 4,000 people. So to actually have people in the room and shaking hands and talking about what we do and seeing how we can help you is just fantastic. Before we go on to who's coming up, the usual housekeeping, please. There's no fire alarms planned for today. If there is, fire exits to your left. Muster point is out in the car park. Mobile phones on silent if you don't mind. The team here will throw a wobbly. There are some physical copies of today's presentation that will be available at the end, towards the back of the room. They're fairly limited, so if you do want one, fight your way to the back to grab it. And if you haven't already guessed, the session is being recorded. Adam, thanks very much, at the back there. So in around about a week's time, we'll be sending you all instructions on how you can watch it back. And finally, there are some feedback forms on the table. With 2-year build-up, we're hoping we can nail it today, but it'd be really good to hear your feedback on whether it was useful, how you might use what we're doing today, and how things maybe can be done in the future. So, we set ourselves a challenge for today, a real challenge. There's lots and lots of moving parts in the industry, as we all know, more so now than ever before. So how do we come up with a presentation that covers lots of different market segments in the space of just over an hour, that means something to you and that you can take away? With difficulty was the initial answer, but thankfully, an unlikely team of superheroes stepped up, and here they are. And the team today are going to be taking you through each of these market segments, which you all know we're going to cover because you're here. So just a quick walkthrough. Coming up first will be David Linden. David joined us as Head of Energy Transition. Oh, how long ago was it? 18 months ago. He's a COVID baby. Dan, who's here with us today. So I think Dan's your first presentation. Really looking forward to this. Dan's analyst in our offshore energy services. Dan's going to tag team with Yvonne Telford, who's one of our real experienced team members. Yvonne's senior analyst, it's true, for Northwest Europe. And that'll be followed by Teresa, who I'm very grateful to say rejoined us a little while ago. Teresa, potato. And finally, and definitely not least, we've got Behzad, who joins us to talk about the offshore wind market. So that's the lineup. We hope we stick to timings. David may go over by half an hour, but we'll see how it goes. We're doing things a little bit differently today with the Q&A. Rather than take questions from the floor and pick on a few people and wander around like Annika Rice, who probably half the people don't know who that is anymore. At the back of the room, the team will be available to take individual questions about the market, the presentation, about what we do, whatever you like. There's 10 of us here today, blue badges, and that's your ticket. We'll have some drinks, we'll have some food, and if anyone wants to join us, we'll be going to the OGV tap room, where David is buying the first round of drinks. Thank you very much. And then we will go home, go to sleep, wake up with a headache. If you'll just indulge me, if you like what you see today, please tell people about it. Social media handles are there. Suggested hashtags would be, isn't this the best thing I've ever seen? Will you get on with it? And he wants to be John Oliver. I'll re-show this slide at the end, but everything you see today is derived from one of these products or one of these services. We are really passionate about the industry. We've been doing it a long time, and it really matters to us that we're the best at what we do, that we're specialists, and that we're independent. And the reason why that matters is because it affects your businesses, and hopefully we can have an impact on the success of what you do. So, enough from me. Breathe. David Lind, everybody. Thank you.
Hello, everyone. Hope you're doing well. I'm the guy who's going to buy you a drink afterwards, so you have to like everything I say, clap politely, laugh at my jokes. It's great to be here in, dare I say, sunny Aberdeen. Thank you very much for having us. We flew up from London this morning. In my sort of next 10, 15 minutes or maybe half an hour, I'm going to essentially just walk through some of the key themes we're seeing in the kind of the North Sea region that we think are important to think about when you're looking at this energy basin and how it's changing. I have a slight bias, obviously, as head of energy transition. I'm going to look at some of the things that are causing that change rather than looking back. But hopefully you find that interesting. But essentially, think about this presentation as kind of the context for what you're going to see after me. And then to start off with, really, I just wanted to look at the production profiles of the UK and Norway. I think this is my pointer here. Really just to sort of have a think about what are we, as the two main oil-producing regions, oil and gas-producing parts of the North Sea. It's really interesting in my mind just to look back and see where we've come from and where we've gone. We've just plotted basically production on each of these two here on the left-hand side. And really what the story in my mind says, and I don't want to sound too negative, but essentially it's a story of decline, right? So there's been a lot of success in the past, but now it's a story of decline. UK's been essentially, I guess, declining since the 90s, and Norway's about to start that own process there. Now, the big difference, of course, is that the UK has about 30% or so of the reserves left relative to what Norway has. And what you're looking at is a much more fragmented, much more complex picture, many more hubs, many more companies involved, et cetera, which makes the whole commercialization process much more difficult as well. It's just useful to look at it in that context to start with. I don't want to talk too much about that. The rest of my colleagues will talk about this aspect in much more detail. But essentially, while it is I'm labeling it a story of decline. Again, please don't look at that too negatively. Of hydrocarbon production, the world has, of course, changed a little bit recently. Essentially, we have moved from the conversation, which is purely about energy sustainability. Let's go all out for that. That's all we need. Essentially, what we need is, in my mind, a return to the energy trilemma, if anyone's familiar with that. Essentially, looking at affordability, security, and sustainability in your energy supply. It's quite a common concept, and so far I think the balance has been very tipped towards the sustainability angle for the right reasons, of course. But this picture here, I won't go through these charts in too much detail, essentially tells you, we are missing a little bit of the security part of the picture as well as the affordability part. And so the UK in particular here, and I just want to focus on the UK first in this presentation, if it's in a picture of an import dependency but has domestic resources, is there not an opportunity for the UKCS to come back to life, should we call it, in that sense, and participate in the opportunity there? So if you think about the UK in itself is currently import dependent for about 50% or so, at a kind of very rough level, what are you looking at? Well, you could argue that you just need to double production, essentially, right? You need to get another 1.5 million barrels of oil per day in the system. And in that sense, that would allow you to solve the problem of our oil and gas demand picture, not needing to import anything. So that's a big opportunity in my mind. But of course, with an energy transition, you also expect demand to decline. So what I have done, and apologies, this is just a small part of it, but this little sort of curve here that I've put in is the CCC, so the Committee for Climate Change, oil and gas demand outlook for the UK, which essentially from today, which will be up here somewhere, would start to decline down about 70% reduction from today until 2050 in oil and gas demand. But if you look at UK production where it stands, and this blue line is essentially current production going all the way down here, this is our outlook, you still have a massive gap to fill in terms of imports, essentially, during a period of time. So it's not just an opportunity today, it's an opportunity going throughout the energy transition to try and fill that gap. So what is it that the UKCS can actually do to help fill that gap. So we in our Atlas solution, so Yvonne, who works in the Atlas side of things, there's a banner at the back, and you can ask us more about that product in a minute, but essentially it's our Northwest European EMP solution. In that, we capture about 2.3 billion BOEs of what we call undeveloped discoveries. 635 MMBOEs of that's what's called near-term developments. So these are developments that essentially don't have government approval yet, but are really far down the kind of commercialization route. And we're talking about things like Cambo and Rosebank, et cetera. Those guys, once they get there, essentially, they represent this sort of additional slither also of production that can come into play. So, we talk about these, there's big political discussion about them, but they do only add a little bit of extra production overall in play. There is another what we call commercial discoveries in that sense, 1.6, that's the remaining of the 2.5 also. That essentially, if, and of course the big question is if that actually gets developed, you can add another chunk of production in as well. So essentially what you're allowing yourself to do is flatten the curve of production for a good few more years. And so that, if you think about where we're at right now, the resources we've discovered and the ones that could potentially become commercial, that's the situation we're in. So that's not quite doubling production just yet. So the question then is can further exploration help achieve more? So exploration's going to be up. Yvonne and Dan are going to be talking a bit more about that and what's going to be happening in that space. But we've got more wells being drilled this year than the last couple of years. And of course, there's a new licensing round to come into play as well. So can that create more opportunity? We all know that there's a time lag between the two things as well, of course. So in the last sort of 20 years or so, the average has been a sort of 5 years. Now, there's a big band. There's almost 1 year to 16 years in that whole band of discovery to online, essentially. But on average, about 5 years. So we can, in theory, go, OK, well, maybe we can just continue to flatten that curve further out. So there is an opportunity, that's for sure, but it doesn't solve the problem, in my mind. And of course, the question is, can you even flatten that curve? And of course, part of the issue is the UKCS continues to have its own challenges in terms of development. First one of those is commercial viability. A lot of these things are simply not being developed because they're just not commercially viable right now. I think we know that already for many folks in the room here. They're just too marginal for companies to make that decision. Secondly, as production declines, essentially hubs are going to close, access to infrastructure is going to be more difficult. That's going to make development more complex as well. If you think back to that fragmented thing I was talking about just on my first slide. And then finally, of course, the climate environmental pressures. And this is either politically, but also more generally thinking about emissions and how important emissions are as a kind of a goal that we set ourselves as an oil and gas industry as well. So the pressure is going to increase on that. So if we then stick with the idea of upstream emissions, one of the key indicators, because of course the commercial side, et cetera, those are things that companies need to sort out, governments can get involved in, et cetera. If you think about the UK emission side of things, there's a couple of interesting things that are coming out from this. For those interested in emissions, by the way, we've just introduced that in our Atlas solution. So this is all brand new stuff. Stuart here, who's part of the team, he's done a lot of the work behind this, so feel free to grab him afterwards if you're interested in emissions. What the UK has, and again, if you've looked at this before, this shouldn't be too unfamiliar for you, but essentially you've got a more mature basin that has older platforms in it, producing less than you maybe should expect a platform of that capacity to produce. So that means you're essentially getting quite a high, or higher certainly, emissions intensity than you would do something that was brand new kit and producing a full production. But that therefore means emissions intensity is relatively high. But because production as such is about to decline, hubs about to close, et cetera, interestingly, if you were to plot the kind of target that we set ourselves during the transition deal, we're actually going to be meeting those targets. I don't want to say relatively easily, because I'm sure some people put their hands up about that one. But in essence, it doesn't look like there's too much of a trouble of meeting the targets we've set ourselves as reducing emissions, because essentially production and hubs are just going to decline so much that you can achieve that. Happy to discuss that further afterwards, of course, if anyone's got a different view. But of course, if you start adding more production, oil price remains high, etc. We've just done a bit of sensitivity work here. I won't spend too long on it. You're going to get different emissions intensities because you have older platforms staying on for longer. So there's more emissions, but also the intensity goes up. So just from a kind of what we said we would do in the transition deal kind of perspective, it is really important still to think about emissions and how you deal with those and what that means as an industry. It's not just that it's going to decline, it's okay kind of story, which I hope justifies some of the conversations that continue to go on in the industry. Now, if you look at Norway as an alternative and sort of a comparison, essentially, right? So we're looking more at a kind of 7 to 8 kilograms of CO2 per BOE compared to the UK, which, if you remember, was closer to the kind of 20 mark here and hovering around that there. And that is essentially because, if you recall back to the structure of the industry itself, you've just got fewer, larger, newer production platforms, et cetera, to deal with here, which are sometimes either partially, or fully electrified. So if you think about the industry where it's at, and of course it's been incentivized in different ways through taxation, et cetera, or tax incentives, to go down this route, it's just the structure and the nature of the industry which essentially leads to a very different emissions profile. And also we just, we track all the different sort of emissions, electrification outlook here. We just sort of map that on this lovely map here. But essentially, that's allowing Norway not just only to have a really good emissions intensity now, but it's going to continue to reduce over time as well. So we just have to think about the structure of the industry very different to the one we are in the UK for that reason. So I've spoken most about oil and gas there. Of course, the basin's also changing. The North Sea as an energy basin is evolving. And again, I think everyone in the room knows that in some respects, but it's useful just to try and understand how and why and those sorts of things. So while the oil and gas industry is working out its role, governments all around the North Sea, so I've just listed a few of the key ones here, essentially all of them have said they're going to be net zero by 2050 or even sooner as well. Now, what does that mean? It's meant that targets are being set. So I've just highlighted the offshore wind targets and the hydrogen targets, or P to X, or Power to X, if you're not familiar with that. Happy to talk about it later. Targets which are essentially driving big investment into this space. And I just thought this chart was useful to see, if you're looking for an S-curve or the start of an S-curve, that's what it looks like, essentially. The offshore wind capacity in the North Sea has just gone up massively in that period of time. And essentially, this is what everyone else is expecting with all the different other technologies that are being supported during that time. And essentially, a lot of countries are now doubling down on this, right? So UK, Germany, Netherlands, they have all upped their capacity targets. If anyone was watching the EU yesterday, the Repower EU strategy, which is, yes, meant to be about reducing reliance on Russian imports, essentially is also about reducing fossil fuels even further, even faster. Again, whether it's all doable, the question is another matter. But the fact that governments are pushing even harder now basically means you're going to see even more of these targets going up and up and up and up. And in the next decade, so what we've done on the right-hand side here is just from hydrogen. A lot of people say, well, what's happening in hydrogen? I don't actually see that many projects happening. Essentially, in less than 10 years or so, we're tracking all these different projects, both blue and green, across UK and Norway at the moment. If you compare the kind of oil and gas side of things to the hydrogen side of things, there's a huge amount of activity going on. So I think we're tracking something like 48 or so projects, who then have multiple phases just in the next decade who are going to be coming on stream. So there's a huge amount of activity happening that we're now paying attention to a lot more. And because CCS, because CCS is something that's been talked about a long time, and there's common criticism, oh, there's no business model, this will never work, et cetera, et cetera. Well, I would beg to differ. I mean, the activity levels, the timelines, et cetera, while yes, many of them are still officially in concept stage and those sorts of things, that has ramped up significantly here. So I just thought, I love a good map, so I thought I'd put up a couple of good maps just to show, where are some of these key storage sites and in which areas are essentially feeding into them. So again, this is part of the work that we're doing with our own solutions. So our Atlas solution essentially is going to become much more of a kind of new energies and oil and gas solution. We're able to track both of these areas. And just in the next 8 years or so, all these different storage sites are now saying they're going to be online and they're going to have massive amounts of CO2 that they're going to be capturing and storing. And if you watch it really carefully, it's just trickling through very slowly MOUs of waste to energy or trash companies also trying to get rid of their CO2 and shipping them across to Northern Lights, for example. Actually, Northern Lights has been really active, and look, I mean, they're expected to come on in a couple of years properly. So there's a huge amount of activity to follow here that we are quite excited about. So, probably coming up to my half an hour mark in just a minute or so, but I did try to rattle through. I'm good, excellent, perfect. So one thing I did just want to do then to sort of go, okay, so hang on, all you said there, that's great, nice maps. As I said, I love a good map. What about the numbers? What is that looking like? And I thought I'd take some of the two sort of most obvious sectors that we've got. We've got oil and gas and offshore wind, so offshore oil and gas and offshore wind, EPC spend, so essentially what are people spending on to build new kit on, essentially. And in the past, the story has been, it's bounced around a little bit. If you go further back, obviously, there's even less offshore wind in that pie. And then, this next year or so, oil and gas is certainly going to get much more of a boost, obviously aided by current pricing, et cetera. But certainly the pipeline is already stuffed very full of the offshore wind activity in kind of the North Sea area, right? So this is not just UK, this is the North Sea as a whole to consider. So that's, written the countries down here, but Germany, Denmark, Belgium, and Sweden, et cetera, as well. So you just need to think of the North Sea as a broader space. But I thought, in my mind, that's, if a picture doesn't speak 1,000 words, I think that was really important just to show, just to give you a sense of where things are going. So, key messages. Essentially, it says it up on the screen here, right? Essentially, we do think it's a bit of a, as we all know, a story of decline, but there is an opportunity because the profiles are so different between UK and Norway, and the opportunity is there for the UKCS to help fill that gap. But there are technical and commercial challenges that need to be overcome, and maybe the gap can't be filled as much as people would like, but we should continue to lobby to try and make that happen. North Sea emissions performance is variable across the different regions because of the characteristics it has. But certainly if you want to, essentially be a champion for that region or, think more about production, et cetera, it is really important to think about what's going to happen to overall emissions there because we have a North Sea transition deal. We need to keep to that, and we need to think about that as we go through. And then more broadly, of course, the region is changing as an energy basin, and in my mind, certainly there's a great number of opportunities coming up in new energies that we're now tracking, offshore wind, hydrogen, CCS, et cetera. And this is all pre-2030, right? There's a lot happening now. I think people have the misconception it's a post-2030 story. No, it's a pre-2030 story. All right, that's enough from me. Questions are at the end. I'm going to hand you over to Yvonne Telford, who's a senior analyst in our Northwest European EMP analysis.
Thanks, David. Just as a quick unscheduled stop, just to let you know, if you're not already, that David does host a podcast on energy transition called ET Now. If you're not yet subscribed to it, you can do so on the Westwood site. And there's also a monthly newsletter as well, covering a lot of the topics that have been covered today. You can find those all on westwoodenergy.com. Yvonne.
Thank you. I'm short. Thanks for coming along today. Can you hear me? Okay, good. Thanks. I'm kind of tag teaming with my colleague Daniel, who works for our subsea logic platform logic side. I work on the Atlas side. My area is more E&P side. So I'm really just going to take you through a bit more detail in what David's covered in terms of what's going on, the opportunities in Northwest Europe. He basically just took my whole DevEx pack from last week and channeled it into 4 slides, so thanks for that. Made it look far better than I did as well. Let's move on. Let's get cracking. So let's start with the outlook for engineering, procurement, construction contracts. And what we're looking at here on the left-hand chart is the EPC contract values in the bar charts with the numbers. That laser doesn't work, but the numbers basically are the subsea tree awards in the UK and Norway for each of the years. Now, unsurprisingly, the global EPC contract value dropped significantly in 2020 due to COVID and the oil price crash, but we saw recovery in 2021, sorry. Perhaps not so much, we saw the recovery globally, but perhaps not so much in the UK and Norway. In 2022, however, we're currently forecasting about $72 billion of spend, and 2023 forecast is currently standing at $64 billion. Both of these are surpassing pre-pandemic levels, which is great. And as you can see, the Norway and UK areas are recovering proportionally higher. And we're now forecasting about 10% of the UK and Norway spend. 10% of global spend will come from UK and Norway. Also worth mentioning that 2023 is an evolving picture. We're seeing, we've already got line of sight on 81 trees, which are expected to be pulled in and firmed up. And what I'm also going to come on to is talking a little bit more about the opportunities in the evolving marketplace, both the UK and Norway. So we fully expect some improvements on some of the activity numbers and values that we're going to see pulled through in UK and Norway. On the right-hand side here, we've pulled out just a few of the projects that are being progressed for development with expected EPC values associated with those projects in 2022 and 2023 awards. So just those 2 years. There are other opportunities 2024 plus. I should emphasize this isn't all of the projects, but just looking at sort of a cross-section of a few different ones here. So what we have is looking at Wisting, for example, is a Barents Sea project. So when my colleagues have talked about the North Sea, I get a little bit hung up because we do talk about the West of Shetland and the Barents Sea and the Norwegian Sea, of course. But as you can see, Norway is the highest spend expected to come through. Now, this is a significant project. It's opening up some additional hub infrastructure in the Barents Sea region. And as an example of what is involved in that project, we're looking at currently expecting 36 horizontal wells, subsea trees, tied back through 30 subsea templates. So it's a really high template to well ratio that they have there, just because of the reservoir properties and the challenges in that region. In Norway, we're also seeing quite significant standalone developments being progressed. Noaka is well along. Shell's Linnorm is progressing, and we're also seeing some of the older structures, older areas like Valhall being redeveloped, and there's a new central processing platform planned at Valhall, which is facilitating the development of the King Lear project, King Lear Discovery, which will be a wellhead platform tied back to the new NCP, the new central platform. Over in the UK, I guess we all know about Rosebank and Jackdaw. They're coming like A-list superstars now. They're in the press so often. But few other projects that are out there that worth mentioning are, we've got infill drilling already back underway at Montrose, which is great. That was delayed for a few years. And with that will come drilling, hopefully, at Cayley and Shaw, the subsea fields. We're including the East Coast cluster here, which is a kind of renewables project, but does involve, I think, 6 subsea trees. And then we've got the progression of IOG's Saturn Banks project down in the southern North Sea. IOG brought on the first two fields this year, and are now progressing phase 2 with 3 fields being developed. Just check that's all. That was all. So now moving on to kind of looking at the UK in a little bit more detail, just to get the nooks and crannies behind some of the stuff that David said. And I need my pointer for this. So what we have on the top here is what we have in Atlas is our field startups graph with the resources that have either been brought on stream or sanctioned. Down below we have the sanction graph. The resources associated with all of those of the fields that have been brought on stream or sanctioned, and the numbers there. Now, just to take you, and I'm probably going to have to walk for this bit. There we go. So what we have here, can you still hear me good? So what we have had here is in this period was the previous high oil price back in the sort of 2010 to sort of 2014 period. The oil price was high. UK government was introducing sanctions to some tax incentives to progress developments, and we had a wealth of activity going on, not just in the UK, in Norway, around the globe. High number of fields being developed, significant volumes progressing. What that meant, mid-decade, what we saw was a lot of these big fields came on. So these included, the Mariner field, Catcher, Western Isles, Kraken, all coming on stream, followed by Culzean in 2019. But if we look at the field sanctions, although it was really good, we had this first oil price crash in 2014, and then one could argue that the trend has been lower, and that 2016 and 2018 are not actually part of the actual overall trend, but perhaps anomalies. They've maybe just bucked the trend. So whereas when you're in it every year and looking at this, you think that we're in a recovery pattern here in 2016, didn't materialize 2017. We were recovering again in 2018, didn't quite happen in 2019. We've been a peaks and trough kind of industry, and cyclical completely. But overall, the number of fields being progressed has been low, and the volumes associated with it getting lower. And that's because we've got to accept we are an ultra-mature region, and now field sizes are getting smaller. In the last 5 years, the average field size being progressed of all the fields being sanctioned, we're really looking at about 15 to 20 MMBOE. Whereas prior to that, right through, if you go back to, say, 2000, the average field size being progressed in the sanctions was about 35 to 40 MMBOE. So what else can we say here? Well, we know that 2020 was, of course, tough. And it's worth remembering that when things are tough, it's really tough, not just on the oil companies, but the service sector. And we all know the pain of 2020. We also perhaps need to remember that a lot of companies made losses, including the oil companies. They had to cut costs. They wrote off reserves, wrote off value, and actually made losses in the industry. 2021, we were fully expecting to be a year of recovery. We were coming out of COVID. We thought things were going to pick up. It didn't quite materialize. At the start of 2021, we, like many other consultancies and research houses, were expecting 10 fields to start production, and we were expecting 16 to actually be sanctioned in the year. Didn't happen for a variety of reasons. Ended up in 2021 with only 3 fields starting production, which were actually deferred from 2020 because of COVID, and 2 fields being sanctioned. And then with COP26, and then with Cambo decision, this Jackdaw decision in October, where Bayes refused to sanction the environmental statement for the Jackdaw delivery, I think it's fair to say that most of us in this room perhaps felt the industry was, if you worked in oil and gas, at least on the oil and gas side, it felt pretty bleak. It felt a little bit depressing, especially from our side, when a lot of companies were saying, well, what does this mean for developments in the UK, and particularly the larger developments? And it felt bleak, and we didn't know what was actually going to happen. So 2022, and as you can see from the graph, things are looking a bit more positive. Now, unfortunately, this is largely due to the terrible events in the Ukraine, and energy security has come to the fore. And in a period of 6 months, we've almost gone a 180-degree sort of U-turn in terms of the way that perception is in the wider general public, in terms of everything was about the energy transition, but it takes time to transition to that. 6 months ago, we were a net importer, as David said. We were underproducing, as David said. So now we're in the place where energy security is at the fore. The UK government at least, is pushing for more developments. They're wanting a licensing round and exploration this year. And that's good. And it needs to be addressed because it is part of the energy trilemma, and it is part of our security of supply. And that's why we are actually, if I can get the pointers to work, there. 2022, we're looking a bit more positive. We are seeing increased volumes largely coming from Jackdaw and the sanctioning of that, which allegedly is imminent, which is great. But really, only six fields are expected to be sanctioned this year. 2023 is looking more optimistic. We are expecting more sanctions to be pulled through. Volume-wise, huge increase, hinging about 67%, just to throw in a very exact number there that I have written down. 67% of that is coming from Rosebank. So you can see how these large material projects are quite key to replenishing our future production stock. So what about our future developments? So we've got Boris asking us to go produce more, go explore more. What have we got out there, and what are the opportunities? So what we have here, and don't shoot me if your field is not here, which is what happened at DevEx last week, is that what we're holding here over on the left-hand side, and I'll just come out and talk about it a bit more. There we go. So what we have here is a list of 48 discoveries that we, at the moment, are holding as what we class as commercial discoveries or near-term developments. Now, to differentiate those two, near-term developments are those projects which are are pretty well progressed, but perhaps not yet, well, obviously not yet sanctioned. So these include Rosebank. We do still hold Cambo there because it did get to the point of FID. And Jackdaw, obviously. Now, these three projects alone account for about 85% of the remaining reserves of that NTD pool. For the OFS sector and for the Wells guys in the audience, we are currently, based on the current or the previous expectations for Rosebank, let me just double check it. We were expecting, 20 wells for Rosebank, 13 for Cambo, and only 4 via a wellhead platform at Jackdaw. The remainder of these are very small field developments, so not every single one, obviously, but generally what we're seeing is 1 to 2 well subsea tiebacks to existing infrastructure. In the bottom set here, we've got about 1.6 billion barrels of oil equivalent in commercial discoveries, with the top 2 fields here, Clare South and Bressay, accounting for about 35% of the remaining reserves. Again, just showing the potential that we could add to the UK if these projects could be commercialised, but they're challenging. Clare South is reliant on, or is hinging on, electrification for the west of Shetland. And that brings large costs and makes it more economically challenging. Bressay is an ultra-heavy oil field and extremely viscous. And again, that has hindered its progression through to development to date. And then we have other opportunities that are out there. But these just haven't been found. They've not appeared in the last few years. These discoveries have been around for years. So why have they not moved forward? And there's a variety of reasons for this. And so what we're doing here is just looking at some of the technical challenges for why these resources haven't been accessed to date, because this isn't the first time that we've had the high oil price. The pie chart, so what we're looking at here is that 55% of these resources in this pool, of this 2.3 billion barrels of oil equivalent, are technically challenged. But it's worth emphasising, there's technical solutions out there. There's nothing that is completely new, and there's technology exists for it all to be developed. The challenge is doing it economically and getting it over that economic sanction gate. But 45% of these resources, still a lot, they're conventional, so why have they not moved forward? So one of the things we've looked at this, we've looked at a host of reasons, but one issue that is impacting it is ownership. Now here, we're not looking at ownership per se, we're looking at the operated resources. So these are the operators of all of this 48 discoveries. And I've color-coded it by type, just to try and highlight, the majors, the large caps, mid caps, NOCs, small cap companies. Now, 24% of the resources in this commercial pool are held by small companies. And many, not all, but many have struggled to get access to finance, be it from the banking finance community or be it relying on farming partners to help fund the development. Larger companies, mid-sized companies, NOCs, they have probably more than one asset and therefore competing for capital, be it from other domestic assets, international assets. And something we're seeing now, particularly with the majors, is that there's some heavy investment going into the renewable sector. So now some of these opportunities are competing for capital against the renewable energy sector of those companies as well. As David mentioned, something I've not covered, I don't want it to be depressing because we can do this. The good thing is though, right, and I will come back to a positive, there is a race against time. In other sort of previous presentations that we've given, and something that David alluded to, but I don't pick up on properly, is that we've done analysis in terms of hub closures, and in terms of the processing hubs and how quickly they might close in the next 10 years. And based on a $65 oil price and our current models with existing plans for infill drilling programs, etc., we currently estimate that over 50% of the hubs could be closed by 2030 without further investment. Now, what that means is there's a continued race against time, just like there was 4 years ago when MER was a big topic, that we need to progress some of these, and we need to do it quickly because they're going to extend the hub life and therefore keep more opportunities out there so that exploration targets will have somewhere to tie back to in the future. But the positive, not to be too negative, the positive is that we are in a high oil price environment. And small companies are reporting that the banks are phoning them, that they're in discussions with farming partners, etc. I think Jersey are in discussions to progress the Buchan field development. So that's great news, and it brings more opportunities to the UKCS. Now moving on to Norway, and as David said, UK and Norway in a very different position in terms of where we are in our life cycle of oil and gas production. UK has 30% in terms of the remaining reserves compared to Norway and the UK. So if we start again, very similar chart, and just to point out here, there we go, just to point out that axis is actually 3 billion barrels of oil equivalent. You probably didn't spot it, and well done the eagle-eyed amongst you that did, but the UK was 700 million barrels of oil equivalent. So looking at a different scale there completely. The Johan Sverdrup effect, from sanction to startup, pretty obvious. Wish we could find one of those. But overall in Norway, the number of fields being pulled through for development has been relatively small. They haven't actually got huge numbers of fields being developed and tied back every year. And that's why I put this little chart in here. As David showed in the earlier slide, Norway has consistently reinvested in its infrastructure. It has been very lucky that it has had the resources and to enable that to go ahead. But it has had quite a consistent investment over the years. And one thing is particularly interesting here is that in 2020, they didn't see this plummeting investment levels that we saw globally, and particularly in the UK. And why is that? Well, down here, you can see this uplift, and that's not just linked to oil price. Now, whether you work in Norway or not, you may or may not be aware, but in 2020, when the oil price crashed and the rest of the world was just slashing capex spend left, right, and centre, NPD put forward some tax incentives or some tax changes. Now, in Norway, the tax regime has been very steady, but very high. But they have a lot of companies paying tax as well. So they were also able to introduce some tax measures. And the reason for the tax incentives and the tax measures they introduced, the temporary tax package, was to support the service sector and stop the energy companies, the E&P companies, slashing the capex spend. So they incentivized some tax incentives against the special tax, which was rated at 56% for all capex spend in 2020, 2021, and then also for new developments. So the incentive applied to new developments up to the production start date. So as I said, the reason for that was to support activity. So just going back to this graph, we can see that not only did it sustained activity, but what we're seeing now is this increase in spend from near-term developments. And in essence, what the measures have done is not just support it, it has kept the investment going, but what historically Norway was pretty poor at was maintaining the sanctions. So they had some great fields coming on, but they'd have years where nothing was happening. And this didn't trend with oil price. They kind of just did their own thing. But now what we're seeing is an upsurge in activity, because one aspect about these new developments is that the PDOs, for submissions, so the FDPs equivalent in Norway, have to be submitted by the end of 2022, and they have to be approved, sanctioned by the MPD by the end of 2023. So what that means is we have a tidal wave of PDO submissions coming through this year in Norway, and the NPD is going to be extremely busy between now and the end of 2023, pushing through these, reviewing these applications and pushing through the sanctions. So very quickly, just similar to the UK, what we looked at in Norway was just the pool of sort of the unsanctioned commercial discovery pool. Kind of split these into three parts, though. So we've got the NTDs, which account for about 1.8 billion barrels of oil equivalent. And then we have this middle section. Now, we have more granularity on the progression of projects. There's a number of companies who have stated, we're looking to fast track this, we're evaluating this discovery. Even appraisal wells that are expected this year, where they're working up the project alongside the appraisal drilling so that they can get these PDO submissions by the end of the year. So some of this pool will move forward, this 1.1 billion barrels of oil equivalent, some of them won't. And down the bottom are a number of fields with 1.2 billion barrels of oil equivalent there, which are not going to make the cut, but are still fully expected to be commercialized just sometime in the future, post-2023. Technical challenges, not so much, probably as a factor of the abundance of resources that are available in Norway. But finally, just a point, just looking at, again, I just split it out into three sections again, but just looking at the resources by operator. And what will be pretty obvious in terms of the names here is that it's a very small pool of operators. In fact, there's only 11 operators that are progressing a lot of these developments. And that number is actually going to go down to 10 when the Aker BP Lundin merger completes at the end of this quarter. And therefore, the size of the prize in Norway is large, huge, in fact. But there are fewer contracting opportunities, I guess. Fewer companies, fewer operators, perhaps not the same opportunities. In the UK, conversely, the prize is not as big, still hugely worthwhile. But there are more companies involved. There are more operators progressing them or working them or looking to work them, which increases the competitive opportunities. And now that's a good point for me to shut up, hand over to my colleague Dan on the rest of the EPC contracting opportunities.
Thanks, Yvonne. So, hi everyone. As Yvonne said, I plan to talk about EPC opportunities offshore UK, Norway. To start with subsea outlook. So I've split this into subsea and platform. All of the data on this slide is drawn from our subsea logics. Sorry, all of the charts are made with data drawn from our subsea logics product. And specifically here, we're talking about fields offshore UK, Norway, and we're talking about a 5-year forecast, so fields that we anticipate will reach FID before 2027. To draw your attention to the bar charts on the left-hand side first, here we're talking about subsea equipment and by volume. So we're talking about subsea trees, and on the middle chart, subsea umbilical risers and flow lines. So the subsea trees displays the number of units anticipated for award, and with the SURF it shows length in kilometres. And here we've opted to split up that data in terms of the operators running those tenders essentially. So we can see that Equinor far dominates in terms of subsea trees and SURF. Behind Equinor, we have Aker BP, but they are more like a third of the demand represented by Equinor. Interestingly, as Yvonne said, with the Lundin Aker BP merger, that will create a new operator which will dominate behind Equinor there for demand subsea equipment. Over to the donut chart up in the top right. So here we're still talking about subsea equipment, but we're talking in terms of award value as forecasted by ourselves rather than volume as with the bar charts. So with value, headline figure, we anticipate 11 billion over the next 5 years in EPC award value. And here we've included, alongside subsea production systems and SURF, we've included rigid pipeline. In the North Sea, clearly from the chart, subsea production systems and SURF contribute roughly equal proportion of demand by value. And in the North Sea, there are fewer pipelines relative to other regions, and they make up just 20% of award value anticipated. The first bullet point, though, talks to that pipeline demand. So those are gas pipelines in the main, and projects like Wisting and Rosebank are forecast to contribute to that rigid pipeline demand. The second bullet point highlights that, as Yvonne's already mentioned, the UK, the North Sea in general, mature basin, so subsea tiebacks are very prevalent. And that is a good thing for the subsea EPC outlook, basically. So lots of the EPC value anticipated over the forecast falls into the subsea portion, especially in the North Sea. Next I'm going to stay on subsea, but into a specific portion of the subsea EPC market. And to have a look at power from shore and electrification. So straight into the bar chart on the left-hand side, what we're showing there is length on the y-axis, and that's the length of just subsea power umbilical. So we track different types of umbilical, but for power from shore electrification, we're talking about subsea power umbilical. And there in the bar chart, I have shown just a shorter forecast out to 2023, but the demand for that umbilical by length. So again, Norway makes up a far larger portion, for reasons we can talk about later in the Q&A maybe. And what I really wanted to do here is highlight where that length comes from, and the fact that it is a relatively small number of projects, big projects. So the map shows the projects that contribute to the bar chart, and they're split out by their progression. So starting off with projects that are only in the concept, and then progressing to projects where FEED contracts have been awarded. Well, I should start with the firmer ones first. So where FEED contracts have been awarded, NOAKA, Hitachi have a FEED contract there for what they're calling a 250-kilometre connection. We don't know how many cables, but that's a particularly long length. The carbon storage project, the East Coast Cluster, has an umbilical associated with it to those subsea trees. And the Valhall is a shorter subsea umbilical proposed there to the new platform at King Lear. The large projects at the concept stage, Yvonne's mentioned those, but because they are large greenfield projects, they're talking a lot about electrification. When I move on to platforms, I'll mention this again, but the FPSO planned for Rosebank is a redeployment, but that FPSO is equipped for electrification, and that could be 130 kilometres. of SPU. So that should hopefully whet your appetite on what is in subsea logics and how the data can be drawn out. Next, I'm going to talk about platforms. This slide covers both floating and fixed platforms. So FPS, floating production system. And I'm going to start off talking about fixed platforms with that chart on the left. I'll step round so I can see it better myself. So I think it's helpful when we talk about when we talk about floating platforms, because there aren't many floating platforms in the North Sea. First, to give a bit of a history in terms of awards for floating platforms. If you go back over the last 20 years or so, well, 20 years, there were 26 EPC awards related to floating production systems. So that works out 0.8 awards a year as a long-term trend. There are currently 28 floating platforms installed offshore UK, Norway, 19 FPSOs, 18 floating production semi-submersibles, and a singular spar unit. In addition to those 28, there is the Nord FPSS that's recently been reinstalled following an upgrade. There is 2 shut-in units. So there's the Petro Jarl on BP's Fornaven, and there is a Vessel Frisk FPSS. Currently, both those shut-in units are set to be removed in 2022, which in itself is some form of EPC contracting opportunity for someone with those removals. Back to the awards most recently. Pick out a few units to remind you of when they were awarded. There was I'll stick to the 2 new builds, 2 new build FPS units, because they're not labelled there. The new build in 2017, that was the Johan Castberg, and then the new build in 2018 that has a much lower capex associated with it was the FPSO for Shell's Penguins redevelopment, and that was a relatively small capacity unit, which is why it has a smaller capex figure associated there. Just 2 upgraded FPSOs in 2019, and then in 2022 we expect our first FPS EPC award for a fair while, and that is the new build Wisting FPSO for Equinor in the Barents Sea. So what can I say about the Wisting FPSO? The reason we have it in 2022 is based on we anticipate an FID in 2022 currently, and that was based on, in part, the PDO submitted by Equinor, the environmental statement submitted by Equinor stated a 4Q22 PDO, and Equinor have been quoted as saying they'll sanction, or I shouldn't use the word sanction in front of everyone, they should award EPC contracts alongside that FID. So there is a feed contract that's been awarded for the Wisting FPSO to Aker Solutions. It's set to be a circular unit, and that feed contract has an option for EPCI associated with it. Linnorm in 2023 is another new build unit on the horizon. That is a spar, so potentially the first spar to be awarded since 2008, and that's interesting for a couple of reasons, or that project. It's very uncertain as to which yard could build that unit. So Technip has the feed contract, but there's not an immediately obvious yard. So Hyundai built the last spar unit, but there are reports that they've ruled themselves out of the Linnorm unit. So, there's lots of rumours. One of them is Costco in China to build the spa, and also rumoured is a yard in Finland that was shut by Technip in 2016. So that's one form of uncertainty on the Linoleum project. And another is the fact that one of the stakeholders, high temperature, high pressure specialist arguably, Total Energies is thinking about pulling out reportedly. Rosebank set to be a redeployment. That's quite set in stone now, and the feed contract has been awarded with Altera for that redeployment. Leave it there for FPSOs, but there will be a point in the summary. Fixed platforms, so stating again, UK, Norway, North Sea, mature basin, lots and lots of fixed platforms already installed, 533 if I remember. And we generally see low single digits EPC awards for fixed platforms awarded each year. Again, looking at the last 5 years, it was within that longer term trend. They're generally small platforms. A large one was a fixed platform for phase 2 of Johan Sverdrup. That was in 2018, and that platform was recently installed. So all of those platforms ordered in the last 5 years have already been installed. The spike in 2022 is down to the NOACA project, where feed contracts have been awarded for a lot of those platforms, at least the top sides. Then a 2023 back to long-term average, assuming NOACA is awarded in 22. I believe that is all for fixed platforms, other than to say, with the large installed base, most of our inbound queries for fixed platforms tend to revolve around operations and maintenance contract opportunities. So happy to talk about that later if you come over to have a chat, but obviously beyond the scope of this presentation. But I think I'll leave it there for EPC opportunities, just to flick up mine and Yvonne's key messages. So slightly different picture in across Norway and the UK, but overwhelmingly positive. Tax incentives in Norway and in the UK, positive government policy. To highlight the big number for spend, we anticipate 14 billion EPC contract award, and that's up on the pandemic era. And then thrown in there, obviously we lose visibility longer out into the forecast, but we do still see 4 billion over 24, 5 and 6 additional EPC award anticipated. In terms of floating production systems, we see a return to that long-term average of around 0.8 awards a year. And there, to highlight a number for subsea trees, field developments currently confirmed, so that would be what we call conceptual. That amounts to 210 trees out in the next 5 years. And then lastly, to almost expand on the first point, there's the point for Norway, high levels of EPC expected, and hopefully the UK can follow that trend, dependent on a couple of caveats, support from government and the companies themselves. So that's me for EPC. Over to Teresa to talk about rigs. Thank you.
Okay, hopefully you can hear me. Yeah, okay. All right, so offshore rigs. Change has been a key theme in the offshore rig market for several years now, and I think there's quite a few people in here who are very familiar with that. So what I want to do during this presentation is really sort of evaluate and kind of highlight some of those changes, what that means for the future of the global offshore rig market, but also regionally within the North Sea, and also some of the changes that we've been seeing on the emissions side as well. especially in a time when energy security is kind of at the forefront of everyone's minds. Okay, so there's a lot in this, but just wanted to kind of show some of the key trends in the global offshore market first of all. So firstly, on the supply side, since 2014, we have witnessed an overall reduction in 143 jackups, semi-subs, and drill ships. So the three kind of main rig types that we track. And this was really brought about by a 21% decrease in demand following the crash in the commodity prices in 2014. Then we saw a bit of recovery, but then again from 2020 we had COVID and again lower oil prices. So all of that really kind of quashed demand for offshore developments and drilling, and obviously for rigs to work at those projects. So during this time, the number of new build rigs coming out of yards really kind of came to a halt, and the numbers of rigs being scrapped soared. Additionally, as can be seen by the grey bars on that top graph there, marketed supply also decreased during this time as vast numbers of rigs were put into cold stack as well. Fast forward to the current day, and this lower ready supply, coupled with more supportive commodity prices, has pushed committed utilization. So what we're talking about with committed utilization is not just rigs that are on hire currently, but those that also have some future contracts in place as well. So that's pushed the committed utilization for those jackups, semis, and drill ships to highs that we really haven't seen in several years. In fact, the global marketed ultra-deep water drill ship market is now almost sold out, which is pushing day rates up really quickly, and has also sparked some rigs to be reactivated and also some new builds to be taken out of yards. And really what we are expecting to see is that the supply crunch will almost certainly mean further reactivations and potentially more new builds coming out. So there are currently actually 17 drill ships, 29 jackups, and 8 semis that are available to choose from. Now, really, I guess the main thing the main point to put across here is that we really are now at the start of an upcycle in the rig market. Lower supply, higher demand, and utilization all means one thing, and that is higher day rates. As you can see from the bottom left chart there, rig day rates have really taken a beating over the past decade or so, and because of this, we actually saw several of the main drilling companies go into Chapter 11. However, this quickly tightening market that we're seeing is starting to drive day rates upwards in most regions and segments, with a few exceptions that we do actually expect to see some movement upwards in the coming year too. The drill ship segment, again, undoubtedly has made the most progress, with some 7th generation units now being fixed just shy of $400,000 a day in the US Gulf of Mexico. With that number actually expected to, we're expecting to see some more fixtures actually above that before the end of this year as well. There have also been some notable increases in day rates for semi-subs in areas like the US Gulf of Mexico, South America, and Australia. The jackup segment, we have started to see some movement in day rates there more recently. It has lagged a little bit behind the floating rig market, but thanks to a lot of demand coming out of the Middle East, over the past month or two, or a couple of months, I would say, we are now starting to see supply tighten, and we are starting to see some movement in day rates. So I think that the bottom right chart actually shows quite clearly for that the first time in many years, most new fixtures are now being secured at day rates higher than their previous commitments. As the supply crunch worsens, we expect more costly reactivations or new builds to be the solution, which will only drive those day rates higher. So as can be seen by the two graphs on the left-hand side, 2019 was actually a fairly successful year in terms of contracting activity in comparison to some of the prior years. And because of that, 2019 is still being used as a sort of benchmark comparison year a lot in the rig market. So the top left chart shows that 2020 and 2021 didn't witness as many contract awards as in 2019, due mostly to the market still reeling from the pandemic and those low oil prices again. However, the average duration of those awarded deals last year was slightly higher than in 2019. So far this year, we've seen a lot of long-term deals awarded. Again, a lot of those were coming from jack-up awards in the Middle East, as well as in some other segments and areas as well. And currently, the average duration of contracts awarded is sitting 21% higher than in 2019. Committed backlog for this year to date is up 9% against the same period last year. And if all tenders are awarded as planned and contract options are taken up, there is potential for this to exceed 2019's numbers. Regionally, West Africa, the US Gulf of Mexico and Brazil have already outperformed against last year's committed backlog, with most other regions also on track to exceed last year's figures if outstanding demand comes to fruition. Now, in terms of visible outstanding demand over the next few years, the NOCs are really leading the way. So the majority of this, again, is coming from the jack-up segment in the Middle East, Mexico, Far East, but also from your Petrobras, so in Brazil, which recently launched a tender for 8 floating rigs, and that's for work starting in 22 and 23. And those contracts are for 3 or 4 years apiece, plus options on top of those as well. So we're expecting that segment to continue to be really busy going forward. There's also growing demand for semi-subs, with the majority of this actually coming from the North Sea. So that's what I'm going to cover next. So award activity within the Norwegian and UK semi-market over the past few years, and I would say especially in the UK segment, has been lackluster at best. And from the bottom chart, you can see that similar to what happened with the global supply, the North Sea segment also witnessed a lot of attrition as well. Actually, it was 34%. And really, again, we saw that was in reaction to lower demand, sorry. And the UK-based fleet has been left with around 11 units and the Norwegian fleet 20. But there are a couple of units that tend to go between the two and are capable of working in both. Additionally, there are around 10 rigs that are capable of operating in the North Sea that are currently located elsewhere, but would have quite an expensive mobilization and potentially also expensive reactivation should they be brought into the market. So for both the UK and Norway, 2022, so this year, once again is forecast to be pretty flat in terms of demand and utilization. However, we believe that this could be quite a different story as of the next few years. So looking specifically at the UK semi-market, first of all, starting on this side. So as you can see in the top left bar chart, demand, again, has been pretty depressed in the past couple of years. But we are set to see an improvement, and we could see the average committed utilization for this segment top out at around 87% if all outstanding demand moves ahead and if contract options as well on the current deals are taken up. So the demand outlook for 23 and 24 is considerably higher than what we've seen in the past few years. We're seeing a marked increase in sort of longer-term plug and abandonment campaigns, and also some interesting development campaigns, some of which have been mentioned by my colleagues as well. So several of those are central North Sea and west of Shetland. So yeah, some really interesting potential demand coming out there. So from matching up outstanding demand with the current kind of lower supply, it is quite clear that there may not be enough capacity to fulfill that demand. We know of a few Norwegian rigs being marketed into the region on tenders, as well as some rigs that are also located outside of the region being marketed in as well. There are a couple of cold stack rigs, again, in the region, but again, because of the costs, the really high costs associated with reactivating a rig, we hear from the drilling contractors that really they wouldn't be reactivated unless they had a long-term deal in place first. So average day rates for your mid-water UK semis, again, have been pretty depressed, or very depressed over the past few years, most of which have only been kind of hovering above operating cost level, so around the 140 to 160 mark. But due to this sort of tightening market, we do expect to see some increases over the next year, and we could see day rates hit the 200 mark by the start of next year. Okay, so on the Norwegian side, again, we're seeing quite similar sentiment, although we don't expect to see those sort of higher demand come out really until the sort of second half of next year. And that the increases that we're seeing on the Norwegian side, and again, as mentioned by my colleagues previously, is a lot to do with those Norwegian tax incentives that were put in place in 2020 and which come to an end at the end, come to an end this year. We are set to witness a record number of FIDs this year for Norway, and this means a demand drive for rigs from 2023 to 2026 specifically. Operators are undoubtedly already seeing that there's going to be a tighter market during this period, and that's definitely backed by the fact that we've seen several sort of longer term tenders coming out now, some of which are for projects that don't actually start until 2025. So, you know, I think not only do operators want to secure time on a rig, but they're also very, very interested in securing the right asset for their campaigns. And I think that's why we're seeing some operators moving maybe a little bit earlier than we would have, you know, in the past few years with their sort of tender processes. Similar to the UK market, we expect Norway to be sold out, or if not close to, over the coming years. And this will ultimately drive up day rates, which we expect to move quickly towards $400,000 a day. And then just moving on to the jackup segment. So last year, the North Sea jackup awards actually exceeded that of 2019. And although it has been a slow year so far in 2022 for awards, there are still a few interesting tenders out in the market. Of the 36 rigs that are currently in region, 33 are currently working or have future contracts in place, while there are 3 warm stacked without work. North Sea total jackup supply has actually reduced by 35% in the past 5 years, mostly through attrition of older sort of standard spec units. And there are already 3 more units which are due to leave the region this year for work elsewhere. So the planned, and then we also have you know, something else that's kind of happening in the market, which is the planned Noble and Maersk merger, which I think is creating a lot of interest, mainly because they have been asked to divest 5 high-spec North Sea jackups for antitrust clearance to be able to complete the merger. And we've already heard that there are several buyers kind of circling. And this really poses the question, could more rigs potentially leave the region? Or perhaps a new North Sea jackup player could emerge. But whatever the outcome, we do expect that it will no doubt have a significant impact on the North Sea jackup environment. Okay, so just taking a look at the UK, Dutch, and Danish jackup segment then, so not taking into account Norway here. As a result of more rigs leaving the region and another year of increasing demand, we expect committed utilization to you know, hit close to if not full capacity before the end of 2022. But of course, that all depends on things like your demand coming to fruition, your options being taken up, and such like. Next year is expected to meet or even exceed 2022's demand potential, and it's expected that committed utilization will average out in the low 90% range, while 2024 could be higher still. We are still seeing a few gaps in the market this year, but generally, yes, it's becoming very busy. We really see that the UK government's recent energy security policy could help remove some of the red tape and the bureaucracy that we have seen around those offshore developments, some of which that we've seen or read a lot about in the papers over the past few years. So the likes of Jackdaw and Cambo. And we believe that in doing so, this could provide further development drilling opportunities for both jackups and semi-subs in the region. Day rates in the North Sea jackup segment have remained muted for several years, around the $70,000 to $80,000 a day mark. But we are already seeing evidence that rates will move towards $100,000 a day this year as that utilization tightens and continue their upward trajectory through 23 and 24. Now, not too much to say about the Norwegian jackup segment. Really, it continues to be fairly small and niche. There are a limited number of units within this segment, and due to those Norwegian tax incentives kind of providing more development demand, we do expect to see utilization in this segment, again, just pretty close to the 100% mark, sold out next year and into 2024. Day rates in this segment have held up pretty well over the past few years and are expected to gain a bit more momentum by the middle of 2023. Okay, so just move into something a little bit different here. So really, with energy security now more important than ever, we are witnessing a renewed need to increase domestic oil and gas supplies, along with more investment in the renewable side of things as well. It's likely that offshore drilling will continue to increase over the coming years due to this, and that obviously means further increases in rig utilization globally. In turn, this will result in an increase in CO2 and other emissions from the offshore fleet. However, this issue is not going unnoticed by the drilling community, which are recognizing a need to deliver services in a way that reduces the impact on the environment. There are now a variety of different measures and efforts ongoing to help achieve this, as you can see on this slide, which does look a little bit busy, but just wanted to kind of emphasize that. So a couple of drillers have now set their own emission reduction targets. Many of the larger drillers are investing in fuel and emission reducing systems and retrofitting their rigs with those. A few have now also participated in carbon capture and storage drilling projects, which is, again, an area which we believe could see some potential demand for rigs going forward over the next few years. And further companies are also investing and partnering in new alternative areas, such as ocean mineral or geothermal exploration, offshore floating wind, and green hydrogen concepts. Additionally, behind the scenes, and maybe even more importantly, drilling companies are implementing new processes and internal projects on board their rigs to help cut emissions for their clients. Now, in the past, when I've had conversations with different company types about the energy transition and the rig industry, often people take a side. I think there are both clear challenges, but also opportunities when it comes to this topic, as you can see from this slide. Most commonly, it does come down to two things, however. And the first is demand from the client for reducing emissions during a drilling campaign. And the second is the costs associated with implementing those new solutions or processes. Some companies, such as Maersk Drilling and Transocean, however, are leading the way in terms of the level of investment and in driving new technologies and solutions in this field. From what we've seen to date, more will continue to follow as the opportunities perhaps begin to outweigh the challenges. So just some of the key takeaways then from my presentation. The offshore rig market is now in an upcycle. Demand, utilization, and day rates have started their upward trajectory, and we believe this is set to continue due to the supportive commodity prices, lower project break-evens, and a renewed emphasis on energy security. The North Sea rig market is finally set to record more increases in utilization and day rates off the back of the Norwegian tax incentives, as well as the UK's energy security policy. And we believe most of the segments of the market will be close to sold out over the coming years if most demand moves ahead as planned. And again, as rig activity picks up, the emissions side of the story will become more important. And as has historically been the case, the North Sea will continue to set high standards and show others how the energy transition can be an opportunity for the drilling industry and not just a threat. So now I'll hand you over to Behzad Ayoub for the offshore wind piece, and just saving the best to last.
So thank you. Hear me? Yeah. Thank you for that introduction, Teresa. So I'm Behzad Ayoub, Senior Analyst here at Westwood, and I'll be providing you with an overview of the European offshore wind sector, so looking at the North Sea and beyond. So looking at what's currently operational globally, the global offshore wind market has grown rapidly over the past few years, with global online capacity currently standing at 54.2 gigawatts. On a country level, mainland China accounts for 47% of global operational capacity. So although mainland China is in the top position, on a regional basis, 5 out of the top 6 countries are located in Europe. And in addition to this, Europe accounts for 50% of global operational wind farms and has a much more even distribution on a country-by-country basis in comparison to other regions. Now, the offshore wind market is also at a much more mature level in Europe, and countries with established markets such as the UK, Germany, Netherlands, and Denmark are all aiming to increase their operational capacity by the end of the decade. Several European nations, which have little or no online capacity at the moment, are also in advanced stages of construction commercial scale projects. France is a great example of this, with offshore construction currently underway at the Saint-Nazaire and Saint-Berrieuc wind farms. So now that we have sort of set the scene globally, looking at capacity additions in Europe, Europe is forecast to account for 44% of global operational capacity by 2030. Over 153 gigawatts of offshore wind capacity is forecast to be operational in Europe by the end of the decade. Now, this capacity is expected to come from European countries that already have operational wind farms, as well as countries that are in the process of developing projects. So many countries across Europe have employed net zero targets, with offshore wind acting as one of the key sources of supply to reach these targets. And recent geopolitical issues, such as the current situation in Ukraine, has further motivated countries to ramp up the production of renewable energy. Now, due to this, several countries have recently announced new 2030 capacity targets. So the UK has recently increased its 2030 target from 40 gigawatts to 50 gigawatts, and it has also increased its floating wind target, aiming to have 5 gigawatts of this 50 gigawatts made up of floating wind projects. The Netherlands and Germany have also revised their 2030 capacity targets. The Netherlands has increased its target from 11.5 gigawatts to 22.2 gigawatts, and Germany has increased its target from 20 gigawatts to 30 gigawatts. Also, there are several European countries which have announced longer-term targets. Examples of this include Norway, which has set a target of 30 gigawatts by 2040, and France, which has set a target of 40 gigawatts by 2050. Now, in terms of the 2030 set targets, our current forecasts show that the UK, Ireland, Belgium, France, and the Netherlands have a high likelihood of meeting or exceeding these targets based on the current pipeline of projects that we're currently tracking on our WinLogix database. Poland has a medium likelihood, and Germany has a low likelihood, as the current project pipeline in Germany will only account for 21.3 gigawatts of operational capacity by 2030. Now, in terms of auctions in Europe, there are currently several auctions which are taking place, and more are set to take place in the near term. So starting with the UK, aside from the ScotWind leasing round, which awarded 24.8 gigawatts of potential capacity in January this year, a further 2 gigawatts will be made available in a clearing round scheduled for later this year. So that clearing round is for a, I think, license area NE1, and any company that didn't win a lease area in the main ScotWind leasing round is allowed to participate in that leasing round. Scotland's Innovation and Targeted Oil and Gas offshore wind leasing round has also been revealed by Crown Estate Scotland, and this round will be split into 2 bots, and it is expected to be launched in June of 2022. Finally, in the UK, round 4 of the CFD subsidy auction is currently taking place, and a total of 7.9 gigawatts of fixed bottom projects are eligible to participate. So the successful projects and the CFD auction are scheduled to come online before the end of the decade. Other auctions which are currently taking place in Europe include the Hollandse Kust West tender in the Netherlands and the Normandy and Brittany tenders in France. Now, these projects, along with the projects shown here that are being tendered in Germany, Norway, and Lithuania, are all scheduled to come online by 2030. Looking at Poland, developers have been invited to apply for location permits for 11 offshore wind sites, and these are expected to have a total capacity of over 10.5 gigawatts. And finally, Portugal has also announced that it's planning to launch its first offshore wind auction. This will be for floating wind sites and is expected to be launched in the summer of 2022. Now, moving on to EPCI spend over the next 5 years. We currently forecast that $442 billion of offshore wind EPCI spend is projected to be made globally between 2022 and 2026, and Europe will account for 40% of this spend. Mainland China will account for 30%, and the rest of Asia will account for 17%. Now, in terms of spend on components in Europe, turbine EPCI spend will account for the highest amount, with 59% of spend over the 5-year forecast period being attributed to turbines. Foundations are in second position with 21%, and cables are in third position with 11%. Now, due to the cyclical nature of the offshore wind sector, EPCI spend is forecast to rise between 2022 and 2024, slightly fall in 2025, and once again increase in 2026. Now, looking at EPCI spend amongst the incumbent European nations, the first thing to point out is that the UK is forecast to undertake EPCI spend on offshore wind projects in every year between 2022 and 2026. Now, this is partly due to the CFD subsidy scheme, and these are being moved to happen every year. So the CFD subsidies, I guess, will provide extra confidence and extra financial backing for projects in the UK, and they'll be very important for the country to try to reach that 2030 target of 50 gigawatts. In terms of percentages, UK EPCI spend will account for 53% of total spend over the next 5 years amongst the 5 nations highlighted in this graph here. The Netherlands will account for 25%, and Germany will account for 14%. 2026 will witness the highest amount of spend amongst these countries, with $34.2 billion worth of EPCI spend, and this will come from the UK, Germany, Netherlands, and Belgium. 2024 will witness the second highest amount, and 2023 will account for the third highest amount during the 5-year forecast period. Looking at EPCI spend for select emerging nations, it's worth noting that spend across countries listed in this graph will be at a much lower rate in comparison to the country shown in the previous slide. And this is due to a smaller number of projects being developed in these countries over the next 5 years. So amongst the select emerging countries, France is forecast to undertake EPCI spend in every year except for 2024 over the next 5 years. Now, although France will witness spend across the most number of years, Poland will account for the highest amount of spend, accounting for 32% of total spend amongst the 4 nations highlighted in this graph. Norway will account for 27%, and Ireland will account for 21%. Now, looking on a year-by-year basis, 2025 will witness the highest amount of spend with $16.1 billion worth of EPCI spend, and this will come from Norway, France, and Ireland. 2023 will witness the second highest amount, and 2024 will account for the third highest amount during the forecasted 5-year period. Moving on to the energy transition, as David's mentioned, as the other presenters have also mentioned, momentum is growing. And within the offshore wind sector, oil and gas majors are increasingly purchasing shares in offshore wind projects. So Ørsted is a great example of a company that has fully transitioned from oil and gas to renewable energy, with the company currently owning over 14.2 gigawatts of shares in European projects. And Ørsted is forecasted to have 12.4 gigawatts of owned capacity coming online in Europe by 2030. Equinor has also been an early investor in the offshore wind sector, and Equinor is expected to have 3.8 gigawatts of owned operational capacity in Europe by 2030. Now, other oil and gas majors that are making investments into the offshore wind sector include Shell, BP, Total Energies, Eni, and CNOOC. In terms of countries where investments are being made, the UK is currently the most popular country, and as we can see from the first graph there, all of the companies highlighted in the slide have shares in offshore wind projects located in the UK. Now, outside of their current ownership shares, some of these companies are aiming to increase the offshore wind portfolio by participating in auctions which are currently taking place across the world and in Europe in particular. So Shell and Total Energies are part of separate consortiums that have been shortlisted in the Brittany and Normandy tenders in France. Excuse me. In Norway, 3 separate consortiums, which feature BP, Shell, and Total Energies, have announced their intentions to place bids for the Solij Nordsee 2 offshore wind site. And finally, in the Netherlands, Shell and Eneco have submitted bids for both Hollandse Kust West sites. BP has submitted bids for both sites, and Ørsted and Total Energies are also jointly bidding for both sites in the Netherlands. Now, finally, looking at the global floating wind pipeline, we can see from this slide that Europe accounts for 66% of total pipeline capacity that we're currently tracking in WindLogix. 4 out of the top 5 countries with the largest floating wind pipeline are located in Europe, and these are the UK, Sweden, Italy, and Ireland. Global installed floating wind capacity is projected to reach almost 15 gigawatts by the end of 2030, and it's worth noting that is quite a small amount in comparison to the full installed base, with that only accounting for around 4% of total installed offshore wind capacity. And currently, there is only 145 megawatts of operational floating wind projects globally, and Europe accounts for 113 megawatts of this total. Now, a further 157 megawatts are forecast to come online in 2022, and 114 megawatts of this will come from Europe. And it's worth noting that the Hywind Tampen project, which is located in Norway, is included in these 2022 editions. And once this project comes online, it will be the world's largest operational floating wind project. So in terms of key messages, the offshore wind market is at a much more mature level in Europe, and several emerging European nations are also in advanced stages of developing offshore wind projects. Europe will account for 40% of global EPCI spend over the next 5 years. Oil and gas companies have made visible strides in building their offshore wind portfolios in Europe, and further investments are expected to be made. And finally, Europe will be a likely leader of floating wind projects by the end of the decade. Thank you.
And there we go. Thanks to everybody here from Westwood who's managed to put those slides together. I think you agree it was quite a tough challenge to squeeze all of that into just over an hour, so we only ran over a little bit, and it wasn't even David's fault. As I said at the start, there's going to be a few copies available at the back of the room. The team are going to head back to where the pop-ups are, As we run over a little bit late, the drinks are already being served. I realise I've just told you to go the opposite direction to where everyone's going to be standing, but go and grab yourself a drink, and everyone will be around to give you some brochures and copies. Any particular questions? They're all here. Alicia at the back of the room. Hi, Alicia. Hi. If you've got any specific questions about how you can access any of the data, Alicia will be there to take it. And you can expect some communication over the next week on how you can watch this back and get access to the digital copies. So from me and from the team, thank you very much for coming along, and I hope this has been of use. Take care. Thank you.